Hello, this is Richard Murphy at Tax Research. I'm going to be talking about private equity. That's been in the press quite a lot at the moment. And right at the beginning, I want to make clear that there are two sorts of private equity that operate in the UK and indeed in many other countries. The first invests in new, or fairly new, and small start-up businesses that need capital to bring an idea to market. Now, I have absolutely no problem with that type of private equity activity. There are a few tax issues that might be involved, but generally I consider that activity, which invests maybe 2 or 3 million or so in each deal, of benefit to society and worthy, in all honesty, of getting tax relief, because it does take high risks and the risk-reward ratio does need encouragement. So let's put that type of private equity to one side, because there's another quite different form of private equity, which is the one that is causing concern to lots of people in the press, in Parliament and elsewhere at this moment. And that is the sort that buys out public companies. The biggest example in the UK to date has been the purchase of Boots, the chemist, for £11 billion. Now that's a very different scale of operation. And taking it into the private sector, where the private equity fund then does a number of things to that company. The first thing it will probably do is try and sell as many of its assets as possible, particularly property, which is why things like a retailer of the type that Boots is may be attractive to private equity, and Debenhams was in its turn. That will realise a lot of cash to repay some of the borrowing that the private equity company will have taken on to buy the company in the first place. They will also try to strip down the costs inside the private equity company, which they now own, as far as is possible over the short term to make it look attractive, so that fairly soon after buying it, this whole operation will be put back on the stock exchange again at what is quite probably an inflated price, with substantial assets having been taken out of it in the meantime. Debenhams is the perfect example of that. Now, that is the business model of this type of private equity operation. Ever since I've been interested in economics, and that's been since the 1970s, and I can recall the name Slater Walker and all the asset stripping connotation that went with it, this type of activity has been considered a pretty low form of capitalism. It's, if you like, an accountant's form of capitalism, because it's about cost cutting and financial engineering. It's not about enterprise, it's not about creating value, it's about extracting value. That is the economic model that private equity is in. Now, I don't like it in its own terms, but I don't like it even more because of the tax incentives that it gets to undertake this activity, which appears to add very little in value to any economy, the UK, the US, or wherever it might take place. Let me explain what those tax reliefs are and why they're problematic. Those companies try to make their money, as I say, by making a capital gain on buying a company, stripping it, and then selling it again at a profit. The first tax relief that the private equity fund will almost certainly secure, and which is disadvantageous to everybody else, is that they can realise their capital gains offshore. These funds are registered offshore. Almost all the tax havens have no capital gains tax at all, and as such they get an advantage which any quoted company operator in this market will not have. There's no level playing field. That is a distortion. It makes it much easier for these companies to make money than anybody else. That's not on. That's a distortion in the market. That should go. The second problem is that these companies, these private equity funds, buy their target companies using vast quantities of debt. I'll explain how in a minute. But that debt is then loaded on the balance sheets of the companies that they buy. And instead of paying tax, these companies now pay interest, vast quantities of it. And because the UK is very generous with regard to its tax relief on interest, basically it doesn't ask questions about the purpose for which the interest is being paid, then the profits for tax purposes are massively deflated, to the point where little or no tax at all will be paid. And that means that the UK government is giving these private equity operators an enormous tax subsidy to enable them to basically fleece the UK economy of jobs, of economic activity, of profit, all of which would be of value if left here. Now, that again makes absolutely no sense. It also makes no sense because that interest is paid from the UK, where tax relief is given, to offshore, where the interest, when it's received, is not taxed in most cases, or if it is taxed, it is taxed at very low rate. That is another form of subsidy to this business, which costs a substantial amount a year, probably running into hundreds of millions of pounds. The final form of tax abuse is the one which has perhaps attracted most attention, and that is the way in which these funds are structured. They are structured normally offshore as partnership arrangements. Now, the partners come in two sorts. There are the partners who provide the money, and they normally own 80% of the fund, and the partners who manage the fund, who provide 20% of the capital. But I stress the capital of these funds is tiny. It may only be a few £1,000s in proportion to the billions of pounds that they actually use to acquire the companies that they buy. And the difference is that whilst only a few £1,000s is provided in capital, the vast majority of their money is provided by way of loan by the members who provide the 80% of the capital value. Now, that's important, because the people who own the 20% of the fund managers, they are in all effect employees. But if they were to be employees under any other arrangement in any other industry, they would be taxed upon the 20% profit they get as if it was earnings from employment. And quite rightly so. There is no reason why not. That is how this money is earned. But for some reason which it is very hard to comprehend, in 2004 the UK government made an agreement with this one industry that those rules would not apply to the private equity industry, and instead these people are considered to own what are called non-employment related securities in the partnerships of which they're members, and therefore their interest is considered to be subject to capital gains tax. Now, so long as they own the companies that they buy for at least 2 years before selling them on, that means capital gains tax is paid on their profits at 10% instead of income tax at 40%. You can see that once again they get a massive unfair advantage as a result. And substantial profits are made. Once the debt has been repaid to the general partners, the ratio of profits to the 20% fund is still very large indeed. So there are three fundamental tax reliefs here: capital gains offshore, interest relief, and the unfair way in which the interest of the private equity fund managers are taxed, all of which are abusive and provide an incentive to an industry which is already basically doing nothing constructive. It is asset stripping. And in combination, this means that I believe that the private equity sector is fairly parasitical, but I stress, only with regard to these buyout operations. If it's supporting new ventures to do new things which bring new products to the market and support new managers, I'm happy. It's the buyout activity that is a problem. And there we have a massive issue which requires redressing, and a new system of taxation which creates a level playing field. If they can operate on a level playing field, I can't argue. But when they're being tax subsidised to an enormous degree, and they are, to undertake this activity, then I say, as would any market believer, this is not on. Cut the tax subsidy, do it without it, or don't do it at all.